Well, as the dust settles on the US presidential first debate and the US CPI number, we're seeing tech having an absolutely breathtaking move, with Nvidia firmly at the heartbeat of what we've been seeing. But will it build? That's the question we ask in today's trade-off. We're also having a look at growth and the concerns that have been building in China, in Germany, and in the US as well. And that may keep cyclical stocks and cyclical areas of the market from rising too much. But it also reinforces the Fed put, which is keeping us warm and fuzzy at night. Now, we have a look at trades in the gold. We look at US dollar. We look at cable, various plays on the yen. And we look at what's going on in financial markets. It's all going on in the trade-off. Well, hi, I'm Chris Weston from Pepperstone, and I'm going to join in 2 seconds from Blake Morrow from Forex Analytics. And we will be discussing the financial markets, a little bit cheeky bit of politics playing through and how that feeds into the US election. We're going to be talking about some of the growth concerns playing through, but it's all going on in the trade-off. Mr. Blake Morrow, come into the programme, would you please, kind sir? Yesterday, I think most of the world were US political experts. We were all just looking at it, and I don't think we learned anything too much on in terms of Kamala Harris's policies. To be fair, I don't think we were ever going to do it. It was really a question of how presidential she sounded and how that sort of played into the remaining undecided voters. I'm not sure how you can still be an undecided voter, to be fair, but yesterday we were all US voters in our own right. I was driving along and taking my dog to the vet during that time, and someone Trump started talking about eating dogs. I spat my coffee on the. It was funny, I think. But yeah, I think it was an interesting one. How were you watching that one at home yesterday?
Well, I did watch it with popcorn and whiskey, and look, I want to say a couple of things about it. Ooh. You look at the two presidential candidates, and of course, like you just said, everybody's got their opinions. I would have guessed that Trump would have ran right over Harris. I mean, I think that's what their hesitation was going into the debates. I think she walked away really getting underneath his skin. It was obviously visible. Did she make any points about policy? No, not really. No. And I think Trump should have called her out more on her inability to implement anything over the last few years. Yeah. So all in all, though, I mean, when you walk away from it, you go, well, she did look a lot better than we all thought she would do. And Trump did his Trump thing, and you could see him getting obviously fumes coming out of his ears, and we've seen him in that state many times over the last 8 years.
I think the strategist told Trump, "This is your game plan." I think in the first 5 minutes, he walked away from that game plan, did Trump, and I think he would have come off stage and the strategist like, "Oh, you don't talk to." But I don't know. I think I think the prediction markets tell you who won that one, to be fair, but the markets haven't really done so much. And let's explore the markets. Let's go into the markets pulse. I've called this one Bringing Techsy Back. It's a play on Timberlake Classic. I think some of our people our age didn't know about it. It's a fantastic head. Bringing Techsy back. Anyway, let's talk about the tech trade, because whilst the dust was settling on the presidential debate, we saw that US CPI number coming out slightly hotter on the core number, 0.3%. Obviously driven by owner's equivalent rent, which no one in America even pays. It's not a reflection of economic reality whatsoever in America. But the Fed look at it for whatever reason, and that added about 50 basis points to that core CPI print, and that's taken essentially the 50 basis points off the table. But amongst that, we saw Nvidia trading down into the sort of low 107s, and then bang, up she went, bang, 9% higher from those lows. Now, what I looked at, Blake, in that situation was the zero DTE, the options market, and we saw massive call open interest at 110. It's no surprise when we saw it break through those levels. We saw huge volume accumulation coming through. I think this was an options-driven move. It was a flow-driven move. People, options market makers were having to buy the underlying as it traded through the strikes, and it just perpetuated the move. The question is then, with so much of this being flow, it wasn't really a fundamental story. This was just people chasing, people hedging. Can it continue? But some of the moves we saw, Supermicro, Marvell, Broadcom, massive moves. Is Texi back?
Well, if you think I think it's a swing and a miss with generation. Well, I guess you would be Generation Z. I'm X. You're
Generation Y, mate.
I don't know.
I'm just
sorry. Okay, Gen
1979 was the cutoff point. I'm on the 5th of January, 1980. So
that was a swing and a miss, Chris, with bringing sexy back. But you bring in Texi back anyway. I do agree with you. I think it was a lot of flow driven. I think it was offsides. You talk about the debates the night before. I don't necessarily want to go back there, but you saw Bitcoin sliding. The dollar coming under pressure, futures were under pressure. They're like, oh, look, Harris came out on top. You're going to see a lot of these, moves ahead of these ranges, which we'll talk about here in just one second. But I think you caught a lot of the market offsides too. You had a lot of people leaning into it overnight, and then you've seen this complete reversal, kind of deer in the headlights move. But the question I guess you're probably asking is tech going to be able to lead us a lot higher? And my opinion is the answer to that is going to be no. And the reason why is probably the next topic about the presidential ranges that we might be in. And I think we are going to be in a range. And I think you need to trade this market as a range, probably for now through the next couple of weeks as we, see polling shift and you start to see, whether we get another debate or not. It's probably going to, and there's going to be a lot of headlines on different policies and what these two candidates are looking for as far as their economic policies go. So I think you have to play the ranges. And I think last night and today was a perfect example of that. And I think you're going to be selling into strength here in the next couple of days. But what do you think about this presidential, temperature we're getting into right now?
I think with Harris, it's firmly a continuation. A lot of the policies she have are more on the social side, but on the market side, this idea about any kind of corporate tax hikes, they're not going to see the light of day because, the Republicans, are almost certainly going to win the Senate by the sounds of things. And that will need Senate that will need congressional approval to put tax policy through. So, I think that's initially why we didn't see a big sell-off coming through in the bond market, even though her odds, on some of the prediction sites increased by about 3 percentage points. Some of the green energy plays, the solar plays worked on the day because of what we've been seeing there. But, I think it's just a continuation of what we've been seeing. But let's be honest. I mean, to be fair, Harris is not campaigning on fiscal austerity. The deficit under Biden has increased. It just probably won't increase as much under a Trump presidency. And, we don't know what's going to happen. Obviously it comes down to the swing states and we'll have to see if that debate last night has increased her odds when we see, the likes of Pennsylvania, and we see polling coming through there. The polls will dictate there. So, obviously she did well yesterday. She seemed presidential. You go back to the New York Times poll that came out with Siena poll earlier in the week, 28% of respondents said they wanted to understand more about Harris. And I think they saw it last night. I think, they saw that she looked presidential. She stood there firm. So, does that increase her odds? That's what we'll see. But, I think the contentious points for markets probably won't make it through Congress. So it's probably just a continuation. But I think, on the whole, risk assets want to see would do better under a Trump. Okay, she's got trade tariffs, which is a negative, but there's deregulation. There's the promises of full tax cuts and rollover the Tax Cuts and Jobs Act. So I think on balance is probably more positive for equity risk. But there we are. I think that's it. So yeah, we could see a bit of a holding pattern in the short term as a result of what we've been seeing. Let's talk growth concerns, Blake, because we are climbing a bit of the wall of worry, and the S&P and Nasdaq probably has done its best work this year with very narrow leadership. But China's a concern at the moment. It has been for a while. Commodity trades have been under pressure. I mean, we're talking about Europe, but it's Germany. German industrial production numbers and their car industry looks pretty woeful at the moment. If there's a central bank out there that do have scope to cut by 50 basis points, not probably the Fed now, it's the ECB, but they won't because the hawks won't let it happen. And then you've got the labour market concerns and is the Fed behind the curve there as well? So, how are you thinking about this one at the moment?
Well, I actually one of the commodities that I look at closest, and we're going to look at it a little bit later, so make sure you stick around, is going to be crude oil. And crude oil, I think, is a pretty good you can see it, how it's trading is showing us that global growth concerns are real. But let's not forget, Chris, that we are going into a period where central banks are easing. And I think it's going to take a lot of the edge off, as far as these concerns go, as investors and analysts and traders look beyond what's happening currently, and maybe the rear-looking GDP numbers that we're coming through the market now, and say, but we are heading into a period where central banks are easing globally. So I think these growth concerns, yes, they are concerning, especially in China, for real. But that doesn't necessarily mean that it's a global story, not as of yet. And like I said, we are just around the corner from seeing what the impacts are going to be of a global easing cycle that's coming our way. So
I know November's a long time away in the market size. It's a long way, but it could be a very, very interesting period in markets, because if global growth does continue to soften, if the US labour market does push, let's say hypothetically by that point, above 4.5%, it sets us up for a very, very lively November. The Fed, after the election, the Fed could cut 50 basis points. That's expected by the market. The ECB could go harder. Let's see what happens with German growth, European growth, because it could set us up for a very big central bank situation in November. It could also lead us to a situation where we could see the start of a nice melt up into the end of the year. It typically happens, this freaking phrase you like to use, the Santa Claus rally. But I think if these growth continue,
I knew you're a believer.
I don't see how China's not going to turn around as we see the PBOC blink and go really hard. But the bond market's telling you that China's growth is subdued, and the actions that the government and the PBOC have put in are not working. So I reckon November's shaping up for an interesting one. I just want to finish off the back of those growth concerns, Blake. I mean, look, we've just seen that CPI number coming out. We've got 28 basis points of cuts being priced in for the September meeting. We've got just over 100. But, look, are you firmly in the camp now that the Fed go 25 in September and then 50 in November? There's no October meeting. How are you seeing that?
Well, I think you pointed out, Chris, it depends on growth, and we'll be past the election, so the Fed doesn't have to worry about looking political, and front loading 50 right now, and they're not going to do it anyway based on what we saw. But so the question that we're going to have is how we treat that, because the whole market is seeing it. So we're not going to be talking again until after the FOMC next week. So for me, I'm actually still looking at selling dollars, because I think the market's going to say, all right, market pricing still is looking at another 75 basis points in two meetings by the end of the year. I don't think that's going to change. So the market's going to use that as an opportunity to sell dollars, which therefore, whether it's selling dollar yen, selling or buying euro dollar, after the ECB, depending on what they do tomorrow. It's to be seen, but I still look to play the dollar on the short side, even after the Fed. How about you?
I think the dollar's downside is probably cushioned to an extent. I think it's pricing quite a lot in. But yeah, I think the date for everyone's diary, of course, I know whilst it's ahead, is the 4th of October, where we've got the Fed, we've got the next payrolls number. That's going to be a huge number. The last one was massive. It was the most important data point ever. But the next one will be huge, because, whilst the Fed don't meet in October, if we were to see, the unemployment rate tick up again, back up above 4.3%, and payrolls continuing to be soft, when this is a seasonally quite a strong payrolls number, then 50 basis points is on, because what it does is it's after the election. So any of those Fed members who didn't want to vote for a 50 basis point cut because it could influence the election, which is mental, because there's no way in the world a 50 basis point versus 25 is going to change the voting electorate in any capacity. But if they did, they're going to do it in that one. So that number, 4th of October, non-farm payrolls. Put it on diary, because it's going to be deafening. Everyone's going to be talking about it. Non-farm payrolls party in Vegas, baby. Let's go. Anyway, let's go to It's a Setup. Right, let's go euro dollar. Bring it on. What are we doing?
You're on like Donkey Kong.
Okay, so we've got an ECB meeting in the session ahead. Obviously, that's going to be something that people are watching. Anyone who's got euro exposure, do keep an eye on that one. We do have a 25 basis point cut fully in the discounted into euro swap. So, obviously for me, don't do anything. Don't trade the ECB meeting just because you think there's going to be a cut. It's all discounted in. What's going to probably happen is Lagarde and the statement will pretty much make it out that they're going to be vague about the next meeting in October. We're not expecting a cut there, but then probably later in the year we're going to get one more 25 basis point cut to lead us home. Now, if we have a look at the setup, if we look at that, we are seeing that sort of wedge pattern playing through. We're making those lower lows, lower highs, but the sort of ranges we're seeing are contracting. Typically, one would expect these to sort of break out to the upside. You probably want to chuck that data into a machine learning model or even ChatGPT to find out how that works out. Blake, recognise. But we'll have to see what happens here. So, we're in a bit of a holding pattern on the daily chart at the moment. You can see what's happening there. The behaviour is becoming less pronounced, less convincing. We wait for an upside break, and then it offers some good upside to play through, and it sort of plays into Blake's view that the dollar could have further downside. I'm just waiting for the market to show me. It's telling you what the behaviours of the markets are doing, the collective weight of money's doing. Maybe this comes from the ECB meeting. Maybe it comes from the dollar side, but there's a good setup there, and if it breaks the upside, then I'll probably be looking to shape my bias on that.
Ooh, I love pennants. I love descending wedges like that, Chris. Thanks for bringing that as a setup.
I love it.
All right, and some of my favorite reversal patterns to the upside in this case. My first setup is going to be crude oil, and when you're talking about crude, I feel like this was just a shakeout, Chris. Now that doesn't make crude non-bearish or bullish.
You can't bring up Taylor Swift, mate. She's gone. She's done.
Yeah, well, here's the thing. We broke through all that horizontal support. We almost got to the 161% extension. You can see those little false breakdowns to the downside. Now, I believe if we get back above 68, we're going to see 72 again. So the reason why I say all this is because the market was so hell-bent on being long crude over the last several months, due to geopolitical risks, output, whatever. You can throw a ton of reasoning why people were sitting on the long side of crude. It broke down, got people got them short, cleared out all the longs, and now we're back up above support here by the end of the day. So now that we're trading above 67, I'm just looking for 68. We get above 68, we rally to 71 and change, and then we sell into the rally. I like it as a setup. That's what I'm looking at, Chris.
Gets to 72. What's the saying? Yours.
Yours, baby.
Let's go to gold.
Love it.
Getting a lot of attention at the moment. Why? Because it's doing very little. But, I didn't want to put a Bollinger Band on there because it gets a bit messy. You can't really just see the price action. But, if you look at the Bollinger Band, it tells you what you can see anyway. And that is that we've got this very clear sideways pattern that's taking place. It's here for a reason, though. You can put dollar moves, you can put real rates, whatever. It's here for a reason, and it's consolidating in a final range. It feels to me like the gold market is telling us that they see something, but they're not prepared to act on it just yet. And yet you can see we try to come back down to the breakout level of 24.84. The buyers step in, the sellers just can't push it through those levels. We've tried a number of occasions, but the bulls are saying we're here for a reason, but we don't have the emphasis at the moment. We don't have the impetus to push us through those all-time highs. It feels like the market knows what it wants, but it wants to see further evidence. And that may be, coming in October with the payrolls number. Maybe they want to see some more economic fragility. Maybe they want to see some downside in further downside in Chinese growth. We've got the PMI numbers coming out on the weekend there as well. I don't think it's going to necessarily be geopolitically based, but it's a really interesting setup. The longer this consolidation goes on for, the more pronounced and more powerful the move will be. If we do break out to the upside, and I think people will start to chase it. But I think, as I said last week, I think the gold's best days come through in a series of real economic deterioration, which we're not seeing at the moment in any capacity. But if we were to see real, then people come out and say, I don't want to hold dollars, I don't want to hold Swiss francs, don't really want to hold euros. I don't really want to hold pounds, Aussie dollars. The yen's okay, but then gold becomes a currency in its own right. And then people say, I don't like any of these currencies in G10, but I like gold. And that's where gold will do its best days. But we're not there right now. But I think we're here for a reason. And I feel like, if it breaks out, it's going to go and it's going to rip. Well, we'll have to wait and see how that happens.
You know, Chris, consolidating at all-time highs is usually not a bearish sign. It just usually isn't. I mean,
especially when you look at the defense of that 2484 level. You know, people have tried to take that down, and it just holds. It's holds. I mean, but if it does break down, I mean, that's going to be a powerful message in itself. So, the longer this consolidation goes on, the more powerful, in my opinion, the breakout. We don't know which way that's going to go, obviously, but when it shows his hand, boom.
That's right. That's right. If I tell you, Chris, if I was short, I would be pooping bricks. Okay, but I'm not right now. We're going to be looking at the Canadian yen, and that's going to be my last setup. And this one's going to play into that crude play I was just showing you. Look, I'm still a yen bull, meaning that I expect all the yen pairs to continue to move lower over time. But right now, the Canadian yen hit the 78% retracement. That was at the level of, or came really close to the 103.17 level. We completed a double top. We closed back above the 618 retracement. That long red line that you see there, that trend line, that goes all the way back to early 2020, Chris. So we bounced off this trend line. I think there's some upside here. How far is it going to take us? I don't know. But if crude does actually squeeze, it'll put a little bit of upside pressure on the Canadian currency, and we'll probably see the Canadian yen, rally a little. Yesterday, the yen went down because we had BOJ comments. Then at the same time, the Trump-Harris debate was going on. Could have been misconstrued as bearish equities. You had some yen strength that quickly reversed today. We almost got hammers across the board on every yen pair. So I do think there's some upside near term, and then we can sell into it. So maybe a move back up to 106, maybe a move back up towards 108, 109, and then we can sell into some strength. But Chris, that's the last setup I wanted to bring you guys because it will play into crude.
Thank you very much indeed. Let's go to play of the day. I'm looking at the S&P 500, US 500, and more of a momentum strategy today. So I'm not in the position at the moment, but what I like about this, and Nasdaq's similar situation, is we saw the inside day on Monday. The range came inside Friday's big decent liquidation that came through, and we wanted that to resolve. So we're using Friday's high-low range as a sort of a guide, and we've obviously broken out of that, and that usually dictates sort of near-term situation. So that inside day has reversed itself, or has reconciled itself. We've broken through Friday's high. We've closed above the 5-day exponential moving average, which is now moving higher. But look at that wick that we've seen on the candle. I love that. Really strong buyers. It's been driven by Nvidia. Now it will be Nvidia and the tech plays that need to take this higher. But what I want to do is buy stop orders above today's high, and above the former breakout area, 55.66. So I want to look for a momentum move, and so I'm not in a position, but if the market can break through there, I'm hoping, and it is a hope because nothing's certain, and a lot of these do fail. That the momentum kicks this higher. We're going to see Nvidia continue to trade higher. Microsoft, ARM, AMD, all these kind of names continue to take us higher. Broadcom, and we make a continued high going forward. So we use the momentum in the market to continue to take us higher. I like what I've been seeing from the price action here. There's a probability that this kicks, and I want to be involved in that.
And one thing I just need to add to that, Chris, we stopped at the 618 retracement of that. See those big red bars over the last week? That whole move down, we stopped at the 618 Fibonacci level today, right at the close. So yeah, we break above today's highs, and I'm with you. I think we squeeze a little higher. So
it's one of those things. It doesn't feel right. It doesn't. We talk about the growth concerns, all that's going on. We've now got 25, 50 is probably what the market wanted to an extent. And participation was pretty poor. 50% of stocks were, 46% of stocks were higher. So energy, staples, banks don't look that great. They've come off a little bit, and it's tech that's taken us higher with a little bit of discretionary buying. So, but as I said, the S&P and Nasdaq's done some of its best work this year on narrow participation, with tech taking us high. Now, I don't know if tech's going to continue. I have no idea. Of course, I don't know, but. And so much of it was driven by optionality. But if this does spill over into another big day, then we've got the trade. Well,
you're bringing Texi back, so why not?
Yeah, it's going to catch on. Chris, it will catch on.
It will with Gen X, Z, whatever. Anyway, my play of the day is going to be the sterling, and it's going to go hand in hand, just you and me, Chris, with your euro and my sterling. All right. So anyway, we have a pullback to, and I didn't draw the lower end of it, and I should have. This is actually a big triangle that it broke out of, back in August. And so all we're doing is we're retesting that trend line, the upper end of the triangle. We're retesting it now. It's a 38% retracement. We dipped all the way down to 130. Despite the weak GDP numbers that we got overnight, it's holding above it. So while we're above 130, I think we bounce back to 130, 150, maybe even break out if the euro breaks higher. So this is, in my opinion, when you're dealing in the markets, you're always looking for whatever the best risk reward is. If I can find an entry point, which happens to be where we're at, if we can find an entry point with defined risk, which we clearly can, then, and the reward will outpace the risk, these are trades I like to take. So I'm already long some sterling. I'm looking to actually add to my long position. If we get a positive euro move tomorrow and some dollar weakness, I'm going to be looking to play this one back towards 132. So that's my play of the day.
Well done. All right, thank you, mate. And thank you, everyone at home for watching. And if you want to smash the like button, we'd love that. Tell your friends and family about the show. Subscribe to the channel when you can. And we'll be back next week for more of The Trade-Off. Thanks.